Welcome to The Explainer. So let's just dive right into this, because if you've been glued to your screens watching the Indian markets recently, you have definitely noticed some absolutely wild sudden movements right at the end of the trading day. I mean, we're talking about charts looking like total roller coasters in those final minutes. It honestly had everyone completely confused this week and, quite frankly, a little bit spooked. But today, we're going to unpack exactly what's going on, break down the actual mechanics behind these swings, and, most importantly, figure out what it all means for your portfolio. So, why did the Indian market suddenly swing so hard at the close? Well, we are going to put on our detective hats today to figure out exactly why the market went on this chaotic ride right before the closing bell. Was it some sudden economic shock? Maybe a massive institutional sell-off? The answer is actually way more mechanical than that. Section 1. Unmasking the culprit. The new closing auction session, or CAS. Okay, so our prime suspect behind all this volatility is the National Stock Exchange's brand new closing auction session, specifically for the futures and options, or F&O segment, where traders are basically betting on the future direction of the market. To really wrap our heads around this, imagine a super busy retail shop right at the end of the day. Instead of just slapping a final price tag based on whatever the very last guy happened to pay right before the doors locked, the shop decides to wait. It collects all the last-minute customer bids, what people are genuinely willing to pay right at that exact moment, and then decides the final official price based on the collective demand. And that is essentially what a closing auction is doing for stocks. Here is the massive mechanical shift we're talking about. Under the old way, the exchange literally just grabbed whatever the exact last traded price was at precisely 3:30 p.m., just a mere snapshot in time. But under the new way, the exchange runs a specific auction, collecting buy and sell orders based on real, actual supply and demand. They aggregate all these final orders to find a true equilibrium price. It completely changes how the market finalizes its numbers for the day. Now, the crucial point here is understanding the gap between theory and practice right now. The ultimate goal is absolutely better price discovery. I mean, an auction naturally prevents a single rogue trade at 3:29 p.m. from artificially skewing a stock's closing price. But the reality? We are in a transition period. Traders are still getting used to these entirely new mechanics during these initial days, and that adjustment phase is exactly what led to those sharp, sudden swings. Basically, the plumbing changed, and the water pressure got a little unpredictable. Section 2. The victims. Why options traders caught the brunt. This is where the mechanical change literally hits the wallet. You see, options premiums are entirely dependent on exactly where the index formally closes. When that closing price started moving so unexpectedly during this new auction phase, total chaos ensued. These unexpected moves violently triggered stop losses, those automatic safety nets traders use to sell out of a losing position. Because traders were essentially flying blind in those final minutes, volatility on expiry day spiked significantly. And who usually gets caught in the crossfire? Yep, retail traders. A lot of retail option buyers simply lost money because they placed bets based on the 3:29 p.m. price, only for the auction to settle the final price somewhere entirely different. Moving on to Section 3, the big picture. Is this a market crash? The answer to that is a resounding absolute no. This is definitely not a market crash. We really have to separate the mechanical plumbing of the stock exchange from the actual fundamental economic foundation of the country. Honestly, the macroeconomic realities should completely calm your nerves here, because the underlying fundamentals remain reasonably supportive regardless of what happens in a 3:30 p.m. auction. First off, corporate earnings have actually been better than expected. Businesses are making money. Second, foreign investors, who are obviously a huge driver of market momentum, have started returning to Indian markets. Third, despite all the global uncertainty out there, India's economy remains incredibly resilient. And finally, the Reserve Bank of India continues to meticulously monitor both inflation and liquidity. Literally, none of these core economic pillars have changed just because the NSE tweaked how it calculates the closing bell price. Section 4. The Playbook. Actionable steps for traders versus investors. Now that we've solved the mystery and, officially ruled out an economic collapse, we need a clear game plan. Short-term traders absolutely must adopt differently compared to long-term investors. If you are operating in the market right now, you fall into one of these two camps, and mixing up these strategies is exactly what causes people to lose money. If you're a day trader, the last 15 to 20 minutes of the trading day, that is your new absolute danger zone. Until the market fully adapts to this closing auction session, day traders really need to avoid taking large options positions in this specific window. The unpredictability of the auction right now just makes it a total gamble, not a calculated trade. Your focus should shift entirely to price action during the regular, highly liquid trading hours. Traders also need to keep a few core rules in mind. First off, whatever you do, don't panic if the index suddenly jerks at the close. Anticipate it. Expect it to happen. And secondly, please remember that higher volatility simply equals higher risk. It is absolutely not a guarantee of higher profits. In times of mechanical adjustment like this, reducing your leverage is easily the smartest play you can make until the dust finally settles. Meanwhile, let's totally flip the script here. If you're an investor looking out, say, 5 to 10 years down the line, your strategy requires an entirely different mindset from the day trader. As a long-term investor, your playbook is honestly beautifully simple. Number 1, completely ignore the daily volatility. What happens at 3:30 p.m. on a random Thursday simply does not impact the 10-year compounding growth of a fundamentally strong company. Number 2, dutifully continue your SIPs. Just let the market average itself out over time. And number 3, stay intensely focused on quality businesses and do not, under any circumstances, let short-term mechanical noise alter your long-term investment plans. All right, let's wrap up this explainer. Section 5, the long-term view. Where do we go from here? You can absolutely expect these wild swings to gradually calm down. Markets are incredibly efficient learning machines. Volatility will naturally reduce as traders fully understand the CAS mechanism and adjust their algorithms. As participation in the auction grows, liquidity will improve, which will smooth out those jagged price jumps. Plus, regulatory bodies like SEBI are actively encouraging brokers to enhance price visibility during these exact auctions. As the tools get better and the participants get smarter, the closing minutes will definitely return to a state of normalcy. If you take absolutely nothing else away from this analysis, let it be this. This is a structural market change, not a structural economic problem. We are simply experiencing a mechanical plumbing upgrade in the market designed for much better long-term price discovery. We are not experiencing a breakdown of the Indian economy. So, as the dust finally settles on these new closing options, and as traders learn and navigate the final 15 minutes of the day with just a bit more caution, I want to leave you with a question to ponder. Will you let this short-term mechanical noise derail your long-term wealth strategy? Stick to your fundamentals, adjust your trading hours if you need to, and always remember the big picture. Thanks so much for joining me for this explainer, and I'll catch you next time.